With stock prices coming down, obviously we want our investment dollars to be the most productive that they can be. But is it best to just double down the Magnificent Seven? Or should we look at companies that are at their 52-week low? Or do we want to pick all the companies with the lowest PE ratio?
Because that's what all the news articles are saying. Thanks for tuning in to another episode of Little Thing Called Life with Gus. I, for one, I'm gonna try to keep this simple with looking at two main indicators, and those would be, number one, the PEG ratio, or the price to earning over their 12-month growth ratio, and also the 200-day moving average. 200-day moving average is essentially the day ending the stock price average over the time frame. And I like this as a gauge because it eliminates a lot of the short-term noise, but it's still relevant to notice.
So if we have a stock's price over the past 200 days here in green, then the center line is the simple moving average, SMA. But in most cases, for today's stocks, they're falling below that simple moving average.
All of these stocks today can move further below that 200-day moving average. I believe these two items combined will give us a better understanding of the value with regards to high growth stocks, but I'll also add a couple here and there that don't really fit that mold. Let me explain the PE ratio.
Now, if you're not familiar, the PEG ratio is the price to earnings ratio divided by the growth rate of its earnings for a specific time period. As an example, let's say we have a company with a stock price of $50 and their earnings per share is $2. That gives us a PE ratio of 25. This company has dividend earnings per share growth rate of 30%. Then we have a 25 divided by 30, giving us a PEG ratio of 0.83.
In general, a good PE ratio is below 1, and those greater than 1 happen to be a little less favorable, but in my opinion, the PE ratios are kind of useless when you're looking at growth companies, and the PEG ratio does give us a better view on what opportunity is, and if you're curious, you can get the PEG ratios directly from the NASDAQ website.
The first company will be Qualcomm, which specializes in designing semiconductors, software, and services related to wireless technology. In the global smartphone system on a chip market, Qualcomm held a 25% share in the third quarter of last year, obviously positioning it as a key player. In the Internet of Things chip market, Qualcomm is a major contributor to a rapidly expanding sector. The global IoT chip market was valued at approximately $605 billion in 2024, and it's projected to grow to $1.6 trillion by 2032, with a compounded annual growth rate, or CAGR, of 13.5%. And they've been expanding into automotive chipsets, where it now makes up over $5 billion annually, or 25% of its total revenue. When we look at their performance, they're only up 1.3% year to date, but their PE ratio is very low at a 16, which is pretty good news. They also have a solid dividend over 2%. And when we look at their PEG ratio, it's a 1.76, which is relatively good. As a comparison, a company that is high growth like Palantir has a PEG of 8.08, and a solid company like Apple is at a 2.16, where a lower number happens to be better. Now, the 200-day simple moving average is at $171. While the filming of this today, the stock price is at $155. It's about 10% below that 200-day moving average, meaning that it has a little bit of value to make up.
But obviously, of course, it's not guaranteed. This is just part how I gauge if a stock is undervalued.
And analysts have Qualcomm with over a 29% upside for the next 12 months.
And just a quick note, at the end of the video, I'll be sharing how each company compares with one another with regards to their upside, their PE ratios, and all the key items. Finding undervalued stocks is very specific to established companies, but it's also important to keep looking for new companies leaning in on innovation. And that's where today's sponsor, Loudon Systems, comes in. Loudon Systems was created to help funded startups and developing technology companies get both the productivity of automation, applications, AI, in order to really scale their solutions and potentially reduce overhead. Their other sector is their media production company, which is helping funded and developing technology companies get video right out of the gates. They believe that you don't need to have a Pepsi or a Coca-Cola sized budget in order to get really great quality video in order to help self-service your buyers as well as help self-service your sellers. Leave a comment below if you have a stock in mind that you want me to dig into and see if it's worth the hype, and I'll drill into it.
Our next company is Dell Technologies, and I have to warn you that they are so much more than just a PC company, even though PCs and notebooks do make up over 55% of their business. But their growth area is in AI optimized servers, where the last quarter they saw 37% growth, where the market for AI servers may have a 27% CAGR for the next 8 years. Sadly, year to date Dell is down over 15%, and I want to point out that they do have a dividend of 1.88%. And get this, their PEG ratio is one of the best today at a 0.91, and they have a 200-day SMA, or simple moving average, of $120. That means that the stock price today is already 20% below that 200-day moving average. And analysts show Dell with the potential of 48% upside for the next 12 months. In my research, this happens to be one of those unexpected gems that quickly surfaced to the top. Let's move on to Google, where obviously I think that we all know them as a giant in the internet search, owner of YouTube, and now they also seem to be tinkering around in quantum computing. Most of us know that they are a money-generating machine with their search ad revenue up 12.5% year over year, where Google is estimated to have around a 39% market share of global digital advertising. But despite all of that, they are down negative 13% year to date, with a paltry dividend of 0.36%. But their PEG ratio is at a 1.2, and their 200-day SMA is $175, which happens to be down about negative 5% from the stock price today.
In no way screaming out to be truly undervalued like some of the others, but for a massive company that has multiple pillars of services and a company of this size, it's kind of a gift.
That's why analysts are showing Google with 32% upside for the next 12 months. My next company is Taiwan Semiconductor, where they are the world's largest contract manufacturer for semiconductors for companies like Apple, Nvidia, and Qualcomm. But as you can see on the chart, Apple is clearly their core customer. Taiwan Semiconductors is the backbone for almost all of the AI infrastructure we see today, from GPUs and phone processors and even the Internet of Things chips. They are such a giant in this contractor space that they have over 60% share in semiconductors, with the next closest being at only 10%. And their year-to-date numbers are similar to others, where they have a dividend over 1% and their PEG ratio is at a 0.61. That is truly the lowest of the group today. And their 200-day SMA is at $183, which happens to be 5% off from what it's trading at today. And analysts recognize this opportunity with over 40% upside for the next 12 months.
This is a company that I wish I held a lot more of. Furthermore, the few shares that I do have in my different trading platforms have always brought me a lot of joy, seeing that the opportunity with it being undervalued this much causes a great time to potentially go in as you see the stock go down, because it's a great quality stock.
Moving along to the next company of ASML, which happens to be one of my favorite Dutch companies that makes the lithography machines that allow all of those large foundries to create the physical chips and semiconductors. And they have recently had some pullback in the past year because they had limited selling to China. But now that we are lapping up on those baked numbers, the pasture looks much greener for them, especially with the next 5-year CAGR being estimated at 17% a year for these types of machines. And when we look at ASML's info, they're actually positive year to date, and they carry a small dividend under 1%. And when we look at their PEG, it's at a 1.54, which seems a little high for this group, but I'm only picking low PEG growth companies overall. And their 200-day SMA is $811, which today it's trading 12% below that number. And analysts have this one with over 30% upside for the year.
If the restrictions are even opened up with China, ASML is one of those companies to see a big increase in demand, but they're already seeing a lot of demand with Taiwan Semiconductor moving quickly on their factories outside of Taiwan, like the one being built in Arizona looking to open up soon.
And let's move on to the next company of Adobe, which we know as providing their creative cloud solutions with Photoshop, Illustrator, and other software solutions. They happen to be a company that really helped drive the AI tools that many of us use on a daily basis, with things like generative fill and other features. And they're only doubling down on AI to make their software even more useful. As of now, they happen to have over 40% share in the creative cloud space, and many companies are just chasing them. So let's get into why they made the list. Their current info doesn't stand out at first, but their PEG ratio is a little bit higher than most at a 2.12. But remember, that's still lower than Apple for a little bit of context, which, as I explained, is a good thing. And their 200-day SMA is $498, which is over a 20% difference from where it's trading at today. It's well below average with plenty of room to break out. And this one has a fair amount of love from analysts with over 34% upside. With this trading so much lower than its 200-day SMA, it could pop up any day now. And it has solid financials with good growth trajectory. So keep an eye out for it. Moving along to Amazon, which we all know about their retail site, but Amazon makes their money in advertising and their cloud services from AWS, where Amazon has about a 30% market share in the cloud market, and it's growing at about a 19% a year rate. But an area not many people are mentioning is Amazon's push into the medical area in the form of primary care and pharmaceuticals and pill delivery. It's an area that I believe will be growing very quickly over the next decade. Amazon is down a fair amount this year, but let's cover why they made my list. They have a PEG ratio of a 1.38, which is solid. And their 200-day SMA is $199, where that happens to be about 1% difference from where it's trading at today. It isn't the huge undervalued companies like some of the others, but hey, it's still there and it's much better than a lot of other growth companies. And analysts are showing Amazon with upwards of 36% upside. Now on to Vista Energy, which is an oil and gas company specializing in the exploration and production of oil and gas, with primary operations in Argentina's Vaca Muerta shale formation, where they had a 40% growth in revenue last year alone, and their gross profits doubled. Now they are down year to date like most other companies, and their PDE ratio is pretty low at a 9.5, which leads us to their PEG ratio being at a 0.75, which is the second best of our group today. And their 200-day SMA is $49, which is flat to where it's trading at today. And analysts do have this one with over 40% upside.
I wanted to be able to provide a mix and give people just a little bit of variety and objectivity, and it did beat out a lot of other companies that I have researched. So I wanted to make sure to include it.
Our next company is one of my favorites of Nvidia, and I am happy to see that it has some markers of being undervalued. I'm not going to go into the details about what they're about or what they're producing because I think everybody already knows that. In looking at their info today, they still have a high PE ratio. So let's take the growth into account and look at the PEG ratio, which happens to be at a 1.09, which is very good for a growth company of this size. And their 200-day SMA is at $127. And currently it's trading at $120 while I film this, which has it below that average by 5%. And of course, analysts are very bullish on Nvidia with over 46% upside for the year.
And now with the stock being somewhat undervalued, which makes me happy that I own it. Just a quick reminder that I will be showing all the companies compared at the end so you can see how they all look. Our next company is Applied Materials, which supplies equipment, services, and software essentials for manufacturing semiconductor chips, flat panel displays, and solar products. And with China being a top customer to them in the past, they took a major hit last year where they had to cut down their orders to China as a customer. Despite this, they have a great fundamental and financials with continued growth in semiconductors. They're only a slight down year to date, and they offer a little dividend over 1%. Their PE ratio is quite nice, which then translates to a decent PEG ratio of 1.57, and their 200-day SMA is at $191, which is nearly 20% higher than what it's trading at today. They happen to have great financials, solid growth planned, and they're trading well below their 200-day SMA. Just the kind of opportunity I like to see. And analysts have this stock with over 32% upside for the year. Before I show comparisons of all the companies, I just want to let you know, if you really like this kind of information, please hit the like button and subscribe. It helps me create more educational content for you. That way you don't have to go and do the research like I do every day, and just consider the ones that I mentioned in my videos. Now, as you can see on the screen, is a comparison of all today's companies, so you can see all the key info in one spot. Thanks again for tuning in to an episode of Little Thing Called Life with Gus. Take care.